The price of gold has just hit a one-month high in nearly every major currency as we kick off the new week. This jump came as the US dollar lost some steam in the forex market, right after some dovish comments from a key US Federal Reserve official. And this all happened just before President Trump's big trade tariffs deadline set for the 1st of August. Now here's what's interesting. A bit of drama is unfolding behind the scenes at the Fed. Several senior officials are already maneuvering to potentially replace Jerome Powell, the current chair, who has been taking a fair amount of heat from Trump. In fact, Trump hasn't exactly held back. He's been vocal, criticizing Powell over and over again for not slashing interest rates faster or more aggressively. Last Friday, Fed Governor Christopher Waller jumped into the spotlight, calling for a quarter-point rate cut at the upcoming July meeting, and that set the tone for Monday's market action. So where are we now? Well, gold has been on a steady climb for 3 straight weeks, and by Monday lunchtime in London, the spot price for gold had gone up by another 1.1%. That brought it to $3,387 per troy ounce, the highest we've seen since the 24th of June. Waller wasn't shy in his speech. He said flat out, the private sector is not doing as well as everybody thinks it is. And that really echoed what many investors have been feeling beneath the surface. Meanwhile, Trump ramped up the pressure even more. On Friday, he referred to Powell as a numbskull and accused him of making it harder, especially for young people, to afford a home. Strong words, and they definitely stirred up some reaction in the financial world. Despite all this noise, the futures market isn't quite buying the drama, at least not entirely. As of today, the probability of no rate cut next week still stood at a solid 95%, based on how interest rate futures are being traded on the CME derivatives exchange. Now looking further down the road, the general consensus is that Fed rates will finish up 2025 at about 3.91%. To get there, we'd likely need to see 2 more quarter-point cuts before this year wraps up, which actually lines up perfectly with the Fed's own dot plot projections. That forecast hasn't budged since December, and they've been pretty consistent with it. Meanwhile, the dollar index, that's the gauge of how the US dollar stacks up against a basket of other major currencies, dipped by 0.4% on Monday, dropping to a 7-session low. And while that dip put a bit of a cap on gold price gains for investors using other currencies, gold priced in both euros and British pounds still managed to rise to near one-month highs. Specifically, we saw gold hit above 2,896 euros and 2,507 pounds per ounce. UBS, the Swiss bank known for its role in the London gold market, chimed in with their take. They noted that gold is finding modest support thanks to the weaker US dollar, and they pointed out that the market is now laser-focused on the 1st of August. That's the day the U.S. is supposed to either announce new trade deals or go full steam ahead with more tariffs. Speaking of trade, the Financial Times recently reported that President Trump has taken a much tougher stance in negotiations with the European Union. Apparently, he's pushing for a minimum tariff rate somewhere between 15 and 20% in any finalized deal with the EU bloc. That's a big jump, and it's not just talk. According to U.S. Commerce Secretary Howard Lutnick, who spoke on Sunday, the White House is confident it can lock in a deal with Europe. But again, that August 1st deadline is looming, and it's not flexible. It's a hard cutoff. So to recap, we've got a weakening U.S. dollar, tension at the Fed, climbing gold prices, and some serious pressure on international trade negotiations. All of this is setting the stage for what could be a volatile but opportunity-filled few weeks ahead for investors, especially those watching gold. Before we dive deeper into what this means for long-term trends and how you might want to position yourself if you're tracking gold or FX markets, go ahead and like this video if you're finding this breakdown helpful. And of course, don't forget to subscribe so you don't miss the next update. Let's keep going and take a closer look at what all of this could actually mean for the broader market, especially if you're tracking gold prices or the US dollar over the next few weeks. We've already seen that gold is benefiting from a slightly weaker dollar, and that's no surprise. Historically, whenever the dollar dips, Gold tends to get a little lift, but what's different this time is the combination of factors creating that lift. It's not just currency weakness, it's also policy uncertainty, political drama, and international trade tension, all hitting at once. And the pressure on Jerome Powell? That's not going away. When the President of the United States calls the head of the central bank a numbskull, it doesn't just make headlines, it rattles investor confidence. People start wondering if the Fed is truly independent or if it's going to buckle under political pressure. That kind of uncertainty often pushes investors into safe haven assets like gold. We've seen this pattern before, but what's striking now is how tight the timeline has become. The 1st of August isn't just some random date, it's a hard deadline. If no trade deal is signed by then, tariffs are going into effect. And these aren't light tariffs either. If Trump gets his way, we're looking at an import tax of 15 to 20% on goods from the European Union. That kind of aggressive trade stance almost always leads to turbulence in the equity markets. Businesses hate uncertainty, and when you throw trade restrictions into the mix, they pull back, they delay investment, they slow hiring. And of course, consumers eventually feel the pinch too. That's exactly why gold becomes so attractive in moments like this. It's not just a hedge against inflation, it's a hedge against chaos. Now let's rewind a little and talk about the rate cuts again. Christopher Waller's push for a quarter-point cut isn't exactly a fringe view anymore. Yes, the markets are still showing 95% odds of no cut at the next meeting, but the tide could shift fast, especially if we start seeing weaker than expected economic data in the coming days. And it's not just about the July meeting. Investors are already pricing in multiple cuts by the end of the year. If those expectations grow stronger, we'll likely see more downward pressure on the dollar and upward momentum for gold. Also worth noting is how this all fits into the global context. While the U.S. is dealing with internal tension between the White House and the Fed, Europe and the UK are facing their own challenges, especially with the slow growth outlook and unresolved political questions. Yet despite that, gold priced in euros and pounds has still been climbing. That's a signal that gold is acting not just as a hedge against U.S. risk, but against global uncertainty as well. So where could gold go from here? If the dollar continues to slide and the Fed turns more dovish, meaning more willing to cut rates, we could easily see gold testing higher levels. Remember, we're already at a 1-month high. The next psychological barrier for many traders is $3,400 per ounce. Break that, and we could be looking at a much broader rally. Of course, it's not just macroeconomic trends driving this. The psychology of the market is playing a huge role too. Every time the Fed signals caution, every time Trump makes a dramatic statement, every time there's a flare-up in global trade tension, gold gets another bump. But we should also talk about the flip side. What could stop gold's rise? Well, if the Fed holds firm, if economic data surprises to the upside, or if the White House actually manages to pull off a trade deal with Europe that removes tariffs from the table, those could all be reasons for gold to cool off a bit. Then there's the dollar. If the dollar index rebounds and regains strength, especially if other major economies underperform, that could also slow gold's rally. So while momentum is clearly on gold's side right now, this is still a story in motion. And here's another thing to keep in mind. Market sentiment is fragile. One unexpected data point, say a jobs report that comes in way stronger than expected, or inflation numbers that stay stubbornly high, could reset the entire outlook. But for now, the path of least resistance still points upward for gold. And many analysts are starting to build their projections around that assumption. Let's circle back to the international picture for a moment. The European Union hasn't exactly been eager to cave to Trump's tariff demands. A minimum 15 to 20% tariff is a big ask, and Brussels is pushing back. That means we might not get a clean resolution by the 1st of August. And if that deadline passes without a deal, we could be in for a major market reaction. Think about what that would mean. Retaliatory tariffs, higher costs for imported goods, strained supply chains, and a fresh wave of uncertainty. For gold investors, that's almost like fuel on a fire. Meanwhile, if you're someone trading in other currencies, like the euro or the pound, gold is still looking pretty appealing. Even though their economies are facing challenges, gold priced in those currencies is climbing. That's because it's not just about the dollar right now. It's about what gold represents in times like these, stability. We're going to dig deeper into what all of this could mean for your investment strategy, especially if you're navigating Forex, commodities, or broader macro plays in just a moment. But before we do, if you haven't already, go ahead and hit that like button if you're getting value from this analysis. And if you're new here, make sure you subscribe and turn on notifications so you don't miss the next update. Now let's look ahead and talk strategy. With gold riding high and so many variables in motion, from interest rates to tariffs to political pressure, what should investors actually do with this information? First off, timing matters. Gold has already posted 3 straight weeks of gains. That momentum alone is enough to attract short-term traders who want to ride the wave. But if you're playing the long game, maybe you're a more conservative investor, or you're hedging against inflation and global instability, then this current environment could be signaling a bigger trend shift, not just a temporary spike. Here's what's interesting. The fundamentals and the sentiment are starting to align. You have a weakening US dollar, dovish tones from the Fed, rising tensions in global trade, and a politically charged atmosphere in Washington. That's the kind of mix that usually lays the groundwork for a multi-month gold rally. But as always, there are some key points to watch. One of them is the pace of any interest rate cuts. A quarter-point cut here or there might not move the needle that much. But if the Fed signals a full pivot toward easing, that's a different story entirely. That would likely push real yields lower, weaken the dollar further, and give gold more room to run. Then there's inflation. It hasn't disappeared. And depending on which data set you follow, it may still be lurking beneath the surface. If inflation starts ticking up again while the Fed is cutting rates or holding steady, real interest rates could dip deeper into negative territory. And historically, that's when gold really shines. Why? Because gold doesn't pay interest. But in a world where savings accounts and bonds aren't giving you a real return either, gold suddenly looks like a solid store of value. Let's also talk about investor psychology. When market participants feel like central banks have their backs, they get braver. They buy more equities. They take on more risk. But when that confidence wavers, when headlines are dominated by insults between a president and a central bank chair, or when a looming tariff deadline threatens to derail global trade, people retreat, and often they retreat into gold. So for individual investors, this might be a time to review your portfolio. Ask yourself, are you overexposed to risk assets? Are you relying too heavily on currencies or markets that are vulnerable to interest rate shifts or trade disruption? If the answer is yes, you might want to think about rebalancing, not necessarily going all in on gold, but at least carving out a space for it as part of a diversified approach. There are also different ways to gain exposure to gold. You've got physical gold, bars, coins, which some people prefer for that tangible security. But there are also ETFs, mining stocks, and futures contracts, which allow more flexibility and sometimes even leverage. ETFs like GLD track the price of gold pretty closely and can be traded like any stock. Then you've got mining companies, which can offer higher upside during a gold bull run, though they come with their own set of risks tied to operations and management. And of course, futures give you access to bigger positions with smaller upfront capital, but they're not for the faint of heart. If you're not familiar with margin requirements or roll costs, it's easy to get burned. Whichever route you choose, just remember, the goal is to protect and grow your capital. Gold isn't a magic bullet, but it can be a valuable piece of a bigger picture strategy, especially in times like these when uncertainty is the only thing you can count on. Let's not forget the geopolitical side of things either. The 1st of August deadline is creeping closer, and Trump isn't showing signs of backing down on his tariff demands. If we hit that date without a deal in place, brace yourself for market volatility. Stocks could swing, currencies could tumble, and gold could surge even further. And remember, the markets don't like surprises. Even if tariffs are expected, the moment they're confirmed or suddenly escalated, you often see a knee-jerk reaction. That's why traders and long-term investors alike are keeping a close eye on that calendar. We also have to watch Europe's response. Will the EU give in to the 15 to 20% tariff demand? Probably not without a fight. And if that fight escalates, it's going to ripple through global markets, especially in sectors tied to international manufacturing, exports, and logistics. All of that leads back to one thing: uncertainty. And once again, gold tends to thrive when everything else feels unstable. Another factor to watch: how the dollar reacts. If the trade conflict worsens and starts dragging down U.S. economic outlooks, the dollar could weaken further, which gives gold another tailwind. But if somehow, through some unexpected deal or economic resilience, the dollar finds strength again, gold might pause or even pull back temporarily. This back and forth is what makes gold so interesting and so tricky. It's driven by economics, politics, psychology, and global flows all at once. It doesn't always move in a straight line, but it does tend to follow patterns when you know where to look. So where do we go from here? The next few weeks will be pivotal. Watch the Fed's July meeting closely. Listen for any shifts in tone, even subtle ones. Look at the data: jobs, inflation, consumer sentiment. Monitor the trade headlines, especially anything from the White House or Brussels. And above all, stay adaptable. If you're investing based on last month's news, you're already behind. Gold is telling us a story right now, a story about caution, about risk, about people looking for safety. So whether you're a seasoned investor or just someone curious about how global finance works, this is a moment to pay attention. Because gold isn't just shining right now, it's speaking. And that wraps up our breakdown for today. If you found this helpful or thought-provoking, don't forget to like the video and subscribe to the channel. We'll be back soon with more updates on the markets, the Fed, gold, and what it all means for your financial future. Until then, stay smart, stay alert, and stay ahead.